Today, ladies and gentlemen, we are building that foundation on options. We all want to be able to look out on the penthouse, have that huge top suite, but the only way to get that huge top suite is we have to build up to it. We have to have the foundation. We can't build a skyscraper just with a top penthouse with a beautiful city view. We have to lay down the cement, build again those barriers, floor after floor. And I know you guys want to have the most advanced option trading techniques out there, but you got to learn the basics first. So let's dive into day one of our options bootcamp here, and let's talk about how we can become better options traders. Now, before we start learning more about options, what I want you guys to understand here is option trading is just like normal investing. Option trading is just like normal day trading. And what I mean by that is you have to practice. If you do not practice, you are not going to be successful. For every single trader who just opens up an options account and starts trading right away, you are most likely going to lose on your first, second, third, fourth option trade. Now, I know that's probably what you don't want to hear, but the thing is, we are all bad when we first start. That's how everything is in life. And you have heard these examples a million times, but if you want to make money in the stock market, you have to put in the work to be a great option trader. You can't just pick up a basketball and think you're going to start making three-pointers. You can't pick up a basketball that you've never touched before and start dunking on people. You are going to dribble it off your foot. You are going to miss an air ball. You are going to have to get the hang of it. If you want to be a lawyer, you can't just walk into a courtroom and say, all right, judge, he's innocent. Okay, tell me why he's innocent. I don't know. Right? I don't know what the next part of this court case is because you haven't gone to law school. If you want to be a fighter jet pilot, you have to be in a simulator. You have to go to the farm planes. You have to, again, work your way up to multi-million-dollar aircrafts. It's not, hey, I want to be a fighter jet pilot. Someone get this guy in one of these crazy F-22 Raptors right now. Get him flying. That's not how it works, because if you did that, if you went to the NBA right away, or if, again, you represented someone in a court case right away, or if you guys wanted to become a fighter jet pilot and jumped into a multi-million-dollar plane right away, what would happen? You would lose the game, lose the course, and also, again, lose your life. So we must put in the work. Before you start option trading, please open up a brokerage and do some paper trades with option trading. How long should you paper trade for? Well, you should paper trade until you have 3 months of winning. Not 3 days of winning, not 3 hours of winning, 3 months of winning. Over the next 3 months of you paper trading, you should say to yourself, I am consistent. It took me 11 months of paper trading before I became consistent. Not in option trading, but when I first started in my day trading with penny stocks. It took me 11 months. I lost hundreds of thousands of dollars when I first started trading. When I first started trading, hundreds of thousands of dollars out the window. But you know what? It was fake money. I didn't have hundreds of thousands of dollars in real life to throw away. So that's why I did it on a simulator. And once I started getting good enough and I started gaining education and I started gaining experience, that's when I can carry it over to real money. 3 months of green. If you can't do 3 months in a row of green, why would you go to real money just to throw away your hard-earned cash? Now, the biggest complaint I get out of that is, well, Deck, when I do, again, a paper trade, I don't have any emotions behind it. And paper trading is not to help you with emotions. Paper trading is to give you an education and to help you build experience. Emotion comes from when you actually put skin in the game and when you actually start putting money out there. So what's the best way to be able to take that and be able to be emotional? Because the thing is, a lot of traders say, all right, hey, I was trading 5,000 shares. I was investing $20,000 on my paper trading account. Now again, investing $20,000. I'm so scared I don't know what to do. So we have to build up our emotional tolerance. Your brain, it's going to be just like your arm right here. It's a muscle. Guess what? If I went to the gym and I wanted to bench press, can I again load up 3 plates and start benching 315? The answer is no, because you've never done it before. You start with the bar. Then you add 5s after maybe a month, then some 10s, then some 20s, then some 45s. And throughout time, your muscles start getting bigger because they adjust to the pressure that you're putting onto them. Same exact thing with trading. If you want to, again, go from 0 to all of a sudden 315 pounds, you're going to get crushed. So what can you do? You can start with go down to 1 contract, go to a $100 investment, go to, again, doing 100 shares, do something that's very tiny. And you know what? Your heart's still going to race. You're only going to win or lose maybe $5, but your heart's going to race because now you have skin in the game. And then once you get completely calm, right? Maybe it takes a week, maybe it takes a month, double that. Then now again, you are winning or losing $20 in the day. And you know what? It's real money, but you're again learning experience. You again are going to take some losses. You're going to take some wins. And once you get consistent and you're not again fluttering like crazy, then double that. So what are we doing? We're building up our emotional tolerance, just like we're building up our muscle by adding more weight each time. We don't just go straight to 315 pounds. We go to again 50, then 100, then 200, and we build up from there. Okay? So that's very, very important. Open your brokerage, learn again these courses that we're about to go over here. Keep calm, paper trade first, stick to limit orders, and of course, start working on your strategy. All very important steps. Now, we are going to jump in real quick. This is about a 4-minute video from TD Ameritrade to really just start understanding the basics of our option trading and basics of fundamentals here. So let's go ahead and let's actually just make sure that this is all set, good to go. I'll bring this on up and we're going to play a quick little video right here, team, teaching you straight from TD Ameritrade on the very beginning and basics of option trading. Awesome, and let's begin.
Options trading is an alternative way for investors to invest in the performance of a security, such as a stock or an ETF. By trading options, an investor attempts to capture the up or down movement of a security while only investing a fraction of the cost it would take to own the actual security. For example, consider a stock that's currently trading at $100. If you purchased a share and the price went up $5, you would have a 5% return. With the right option contract, you could profit from this same jump in the stock price while only paying a small premium that costs significantly less than the price of owning the stock. The ability to make more with less is one of the benefits of options trading. However, the potential for greater profits comes with greater risk of losses. To help you understand why, let's take a closer look at how an option contract works. Unlike a stock, when you buy an option contract, you're not purchasing the security itself. Instead, you're purchasing a contract that gives you the right to buy or sell a security at a certain price before a certain date. Consider this example. Suppose there's a coffee shop chain called Stone Curb Coffee. Stone Curb stock is currently trading at $50 a share. An investor believes that the stock price of Stone Curb will rise. This investor considers taking advantage of this anticipated price movement by buying 100 shares of the stock, but she is concerned about the initial capital requirement. Now, let's assume that there's another investor. He already owns 100 shares of Stone Curb stock and plans to hold on to it for a while. He thinks the stock price will not increase much over the next few months. Both investors can utilize a call option. This type of option contract gives the buyer the right to buy shares of Stone Curb stock at a set price, called a strike price, at a set time, called expiration. In this case, it's $55 per share in 4 weeks' time. Typically, each standard option contract represents 100 shares, so this one contract would give the buyer the right to buy 100 shares of Stone Curb stock at $55 per share. The buyer purchases the contract by paying the options premium. The premium, or price of the option, is determined by several factors, including the stock price, time until expiration, and implied volatility, which is how much the stock is expected to move during the life of the contract. This premium gets credited to the seller of the call option and helps to partially offset the original purchase price of the stock. For this example, let's assume the total premium is $100. Our buyer pays the $100 and purchases the contract. Now, let's examine what could happen to this investment. Suppose our buyer's instincts were right, and Stone Curb stock is now selling at $60 a share. Remember, the call option gives the buyer the right to purchase shares of this stock for $55 a share. The buyer could exercise the call and purchase 100 shares for $55 each, and then sell them at market value for $60 each, making a profit of $5 per share, not including commissions. Because shares of Stone Curb have risen by $5, the buyer's contract is essentially worth $500. If our buyer sold her contract, she could potentially make around $400 in profit, the value of her contract minus the $100 premium she originally paid for it, as well as any commissions and fees. While the buyer's investment paid off, things didn't work out as well for the seller. Although he was able to collect $100 for selling the option, he missed out on a portion of the stock's appreciation because he was obligated to sell his stock at $55 per share. Now, let's rewind. Suppose the stock moved in the opposite direction and is now selling for $45 a share on the last trading day prior to expiration. The buyer's contract gives her the right to purchase shares of StoneCurb for $55 a share. Because no one would want to pay $55 for a stock that's selling at $45 in the open market, the buyer's contract will likely expire worthless. The buyer is now on track to lose 100% of her initial $100 investment, plus any trading commissions and fees. For the seller, the option expiring worthless is good news. He still owns his shares of stock and made $100 selling the option. Although the value of his shares declined, he was able to keep the option premium, less any commissions and fees for selling the option. Keep in mind that this is a simplified example. The pricing of options is very complex, which is why it's important to educate yourself about options and their risks before you invest. While the biggest change comes from the price of the underlying instrument that the contract represents, there are other forces like time decay and implied volatility that influence options prices. While we showed you one example, options can be used in a variety of ways. There are call options, which we just saw, that can be profitable to own if the price of a stock goes up. And then there are put options, which can be profitable to own if the price of a stock goes down. Calls and puts can also be combined in a variety of ways. By buying and selling these options, investors have the potential to make money when the market moves in any direction and create strategies with a variety of risk levels. You've taken the first step in understanding options.
All right. So it's very nice to just be able to hear and be able to gauge that. Let me just make sure we're all good. Okay, awesome. And just being able to kind of take this into consideration, get yourself thinking about options a little bit more. Now, at this time, I do want to be able to post a picture in chat, which is just a little bit of a cheat sheet on options and some options trading here. So let me actually just post this over in chat. This way you guys can be able to print this on out and every single person will be able to have this. Now, if you guys are currently just watching this, you guys can take a picture of this on options, how it works, types, advantages, determinants, terminology, and you guys can be able to print this out, hang it on up, or be able to follow along as we go through the rest of this boot camp here. But I feel like this is just a nice little study guide and help you be able to understand the basics a little bit more here. So make sure you guys take that and print that on out. Now let's head back on over to our actual boot camp and let's start, learning a little bit more about our option trading. So, what are options? An options is a contract that allows but doesn't require an investor to buy or sell an underlying instrument like a security, an ETF, or even index at a predetermined price over a certain period of time. Buying and selling options is done on the options market, which trades contracts based on securities. Buying an option that allows you to buy shares at a later time is called a call option, whereas buying an option that allows you to sell shares at a later time is called a put option. So if we want to break this on down, I always like reading the definition and then essentially giving us a DECMAR-Trades definition, which is just making it simplified. So what are options? Options are going to be contracts that we can exercise our right to purchase or to be able to sell shares in a later time until our expiration happens. So if we believe that a stock is going to be going on up, this is going to allow us to be able to tell someone who already owns these shares, hey, I'll give you X amount of money if you allow me to be able to buy these shares or sell these shares at a later price. And if they agree to that, that's going to be able to allow us to make profit. And don't worry, we'll go over exactly how this works. And we can actually skip forward to this example right now. Now, this was an example that I just think is very good. It's a well-known example, an example that I've actually done in the past before because it really helps you understand how options work. So let's say I'm interested on buying this farmhouse. This farmhouse right here costs $200,000, but I'm an investor and I'm saying, you know what? I think real estate is going to boom within the next 2 years. And I think this farmhouse is going to be a great investment coming on up. But at this time, I don't have $200,000 in cash. Not many people do have $200,000 in cash. We can't just go around and start buying these homes, even if we do think it's a great investment. So instead, I'm going to buy a call option on this house that gives me the ability to buy this home for $200,000 within the next 2 years. So essentially what I would do is I would walk up to this farmer and I would say, hey, farmer who currently lives here, can I buy this home for $200,000 within the next 2 years? He may say no, because why would he agree to that? Within the next 2 years, this home price could go on up. So he would want to make all the money, wouldn't he? He would want to be able to make all the profit. So you would say this to him. You say, hold on one second, we'll just call him Mr. Farmer. Mr. Farmer, what if I gave you $10,000 right now? I gave you $10,000 in cash right now. That is yours. That's your $10,000. But since I give you this $10,000, we have to keep this price whenever I want to buy it within the next 2 years. If I want to buy it, if I come to you within the next year or so, you have to sell it to me within $200,000. You might say, hey, Mr. Farmer here, this house could appreciate. You are correct. And that's why I'm an investor. But it also could depreciate. So the thing is, if this house starts depreciating, guess what? I already gave you $10,000 and hey, maybe I still want to get it and I would be obligated to buy it at $200,000 if I want to get involved in it. And you would think and you would say, okay, I agree with this. I like where you're going with it. So at this point, we have the home price, aka the strike price at $200,000. I have 2 years to go to Mr. Farmer since I've given him $10,000 and he signed this contract, and I have a 2-year span to purchase this home at $200,000 whenever I would like. So what could happen? I own a call option that allows me to buy the house at my strike price of $200,000, but the house after a year has just gone by is now worth $350,000. So guess what do you think I can do? I walk over to Mr. Farmer at this point because I saw that the housing market has boomed, and Mr. Farmer is kind of a little upset, isn't he? Because he could be making $350,000, but he signed a contract and I gave him $10,000 that said I can exercise this contract whenever I want. So Mr. Farmer, I would like to purchase this home at this time for $200,000. And he goes, okay, here you go. Give me my $200,000. The farmhouse is yours. Now, what could I do with that $200,000? Well, now I could put it right back on the market for $350,000. And guess what? I just made $150,000. And that's how a call option would work. Now, let's think about it in a more negative way, though. Well, let's say the house is now valued, right, at $150,000. Let's say 2 years are starting to come on up and I'm seeing the housing market actually plummet. I told Mr. Farmer that I was going to buy his home, or I had the option to buy his home over the next 2 years. I gave him $10,000 cash already, and now again, the house has actually depreciated. Well, guess what? Now, Mr. Farmer has $10,000 that he was able to make just out of thin air because I gave it to him, and he still has his house right here. If I want to buy this home, guess what? I could buy it, but I still have to pay $200,000 if I want to buy this home because that was the contract that I signed. He kind of got the better deal here. This fell. I gave him $10,000, and if I want to buy it, now I don't have to buy it, but if I want to buy it right here, guess what? Now again, I lost $50,000. So it's basically an investment, and we're trying to lock it in at the lowest price possible. So my current trade, as you guys know, during the S&P 500 as of now, my strike price is right at that 372 mark. And as we move above 372, guess what? I can be able to exercise those shares any way I want, just like before we have our home being exercised at 200,000, right? Our home value is at 200,000. As it climbs on up, I can exercise my contracts, selling my contracts, and take my profit. As the S&P 500 climbs above 272 to 273 to 274 to 275, I can exercise again my contracts whenever I want, and I get the difference between 272 strike price all the way up to where it's currently at this time. So that is what's so awesome about this. So our strike price, 200,000. Option expiration is 2 years from today. Our option premium is 10,000, right? And because this option has no value, I lose $10,000 if, of course, it starts dropping on down. But if it gains, that's where I make 350,000 or again, $150,000 profit. All right. So that's what's so great about this. So let's start, understanding the essentials of option trading. Option contracts offer the buyer the right, but not the obligation to buy. If I see that I'm losing, guess what happens? Hey, I gave them my premium. I gave them my $10,000. I don't have to buy this farmhouse now at $150,000. I could say, hey, Mr. Farmer, I gave you my $10,000. I'm not going to buy your home, but you get to keep my $10,000. That was part of the deal. The underlying asset at an agreed upon price during a certain period of time on a specific date. Call options allow you to buy shares at a specific time. Put options allow you to sell of shares at a specific time. Differs from stocks as they do not represent ownership. Consider lower level risk than stocks because you can withdraw at any point. So let's start thinking about this in a different way. And the easiest way that I was able to think about it when I first started learning options was, to me, I made it in my head thinking about leasing a car and buying a car. And that's basically what we have here. Okay? So let's think of a very expensive car. Think about a Ferrari. Think about a Lamborghini. Let's think about, a McLaren. We'll just stick with Lamborghini because everyone knows that car. So we want to buy a brand new Lamborghini. How much do Lamborghinis go for? Let's say that this Lamborghini went for $250,000. It's a very nice car, but it's a very expensive car. Now, what could be your problem? Your issue is you don't have $250,000. But you love Lamborghinis and you want to impress your friends and you want to have that ride and you want to be able to drive it even if it's technically not yours. So what could you do? Instead of putting out $250,000, you could lease the car. And the lease could maybe be $4,000 every single month. Now you may have this for a 12-month period. Now this is going to cost you $48,000. Right? It's going to cost you $48,000 to own this car for that 12-month period. But the thing is, this car is not yours, but you get all the benefits of the car. You have this car for 1 year. That's your expiration date. 1 year, you get this car. But this is not your ownership, but you get all the benefits. You can impress all your friends. You can drive the car. You can take it on, take it on dates. You can, go on the highway with it. You can experience it, but you have to give it back at a certain amount of time. So you have to give it back. You get to do everything you want with it, but it's just not yours. The benefit of this is you are paying $200,000 less, but still having the benefits of owning it. Now, that's what we have with leasing and buying. So the biggest difference between options and stocks is that stocks represent shares of ownership in individual companies, while options are contracts with other investors that let you bet on which direction you think stock price is headed. So the thing is, team, let's say you're owning a Lamborghini. And the Lamborghini price starts rising in price. Let's say just like we saw in the last 2 years. We saw that Lamborghini supercars, a lot of these cars, just cars in general, have gone from $200,000 to $300,000. Even though that you own the car at this moment, you have it leased, doesn't mean that you're regardless losing $50,000 because that's the contract that you signed. You don't own it. You can't take it back whenever you want and sell it for a higher price. So obviously when you have shares, those are your shares. You get to sell them whenever you want, of course, later date. With, again, a contract, you only have a specific date. Now, we can see, again, the big difference between stocks and options. Stocks represent ownership in a company, voting rights and dividends. Stocks never expire, no leverage. One share represents one unit, medium to high risk. Options offer no ownership, no voting rights or dividends. All options on contracts eventually expire. High leverage, one contract usually represents 100 shares and are generally higher risk because, of course, you can make more money with even a smaller amount of cash. So, what else do we want to be looking for? We just went over this example. So after this example, we should all be able to understand it. Now let's go over the difference between a call option and a put option. Well, let's start with a call option. A call is an option contract giving the owner the right, but not the obligation, to buy a specific amount of underlying security at a specific price within a specific time. The specific price is known as the strike price, and the specific time during which is made is the expiration time to maturity, the expiration date. Call options may be purchased for speculation or sold for incoming purposes. They may also be combined for use in spread or combination strategies. So a call option is for what, team? We bet that the stock's going to go up. When you do a call, you are betting that the stock is going to be going on up. When we buy a stock option, when you purchase an options contract, you're said to be long. You're a buyer. Being a long on a call contract is betting that the stock is going to go up, while being long is a bet that the stock, when you are being, let's say, short, or a put contract is when you think it is going to be going on down. Your losses are limited to the total price that you paid for it. So this is something that's very important right here, which I do want to take a moment and stop and talk about this. Remember, that example that I went over before with Mr. Farmer. Mr. Farmer, you did not lose any more than what you signed your contract for. So everyone, please listen to this. This is important. You can only lose what your premium is. Once that expiration date expires, just like we had with this house, right? This came on up towards within that 2 years. Within that 2-year period, I went to Mr. Farmer and I said, hey, remember when I gave you $10,000 for $200,000? I want to exercise that. I want to buy this home for $200,000. It was within the contract, within the 2 years. So I was able to do that. The moment that your expiration expires, the contract is no longer eligible. You cannot buy that home anymore. Now, does that mean you lose everything? You can't lose everything. You don't own it. You only lose what I gave Mr. Farmer, which was $10,000. So let's think about this in stock terms now. In stock terms, if I buy Tesla, okay, and I pay a premium for $10,000 for Tesla contracts, if I have these contracts for the next month and a half and Tesla falls and falls and falls and falls, I can't lose. It's not like I'm going to lose forever, right? That's not what I'm going to lose. I'm going to only lose what my premium was, what I went to reserve those shares for. You could let your entire EXP, you could let your entire expiration date go. You're only going to lose what your premium was. For the house example, the $10,000 contract. For the Tesla right here, $10,000. So that's one of the great things about option trading. If Tesla ever fell to $0, you wouldn't lose your entire account. What you would lose is what you paid the premium for, which was that $10,000 contract. Okay? And this is something that why a lot of traders like doing this type of stuff. Because if I own this house, if I was Mr. Farmer, and the house went from $200,000 to $0, it burned down. Just because I have a contract doesn't mean I lost all $200,000. That just means, hey, I gave Mr. Farmer $10,000. The house just burnt down. Obviously, I'm not going to buy it, but you have my $10,000. So the thing is with option trading, know how much your premium is because that's how much you can lose. You can't lose more than your premium, right? And that's absolutely fantastic about option trading. So let's talk about what is a put. A put option is a contract giving the ownership right, but not the obligation to sell a specific amount of underlying security at a predetermined price within a specific time. The specific price the put option buyer can sell is called the strike price. So, as we know, opposite, a put option is a contract that gives investors the right to sell a certain amount of shares. So what does this mean? Sell a certain amount of shares. Does that mean we have to do a call and then we have to do a put to sell? No. What we're referring to, team, is we are referring to a call is when we're going to be going up. A put is when we're betting that it's going to go down. In simplified words, a put contract is just a short. All we're doing is when we put a put contract, we are betting that that stock is going to fall. And it's the same exact thing as with Mr. Farmer. If I came up to him, gave him $10,000 and said, I bet your house is going to become, more worthless, right? It's going to depreciate in value. And that whole entire example would just be opposite. So what is the difference between a call and a put? A call is an option contract that gives you, the holder, the right to purchase a stock at the strike price. Right? Bullish. Then, of course, we have a put, an option contract that gives the holder the right to sell the stock at a strike price, which is bearish. And then, of course, we could short it as well, but you can really just buy and sell calls and puts. Calls, you believe it's going to go up. Puts, you believe it's going to be going on down. Now, the strike price. The strike price is to exercise the price as the most important determinant of the option value. Strike prices are established when the contract is first written. It tells the investor what price the underlying asset must reach before the option is technically in the money. Strike prices are standardized by meaning they are at a fixed dollar amount, such as 31, 32, 33, 102.50, 105, and so on and so forth. So, the price between the underlying stock price and the strike price determines an option's value. For buyers of a call option, if the strike price is above the underlying stock price, the option is out of the money. In the case the option doesn't have the intrinsic value, but may still have the value based on the volatility and time until expiration, as either the two factors could put the option in the money in the future. Conversely, if the underlying stock price is above the strike, the price of the option will have intrinsic value to be in the money. So, I may have lost you there for a second because I know sometimes when you read definitions, you do get a little bit confused. So do I. When I first started, this is why stock trading apparently becomes so confusing, because you read certain things and you're like, what? What are they talking about? And that's why I wanted to be able to break it on down. Let's go back to our Mr. Farmer example. What is going to be our strike price? Our strike price is $200,000. Remember, we have the value right here of $200,000. If it goes above 200,000, guess what? I make money. If it goes underneath 200,000 and the house is now only again worth, 150,000, I lose value here. So I do a call. I think the house is going to go up. The strike price is 200,000. Whenever the house gets above 200,000, that's where I make money. I do a call. My strike price on Tesla or S&P 500 or Apple or whatever stock you want is $100. We get above $100. That's where technically my contract or my shares are at. And anything above this now is now profit because I can sell or exercise it whenever I would like within that expiration date. So that's where I could be able to make money. So we only got one more last thing to add, which we could be able to figure out as well, which is the premium. And the premium is the current market price of an option contract. It is thus the income received by the seller or the writer of the contract to the other party. And the money option premiums are composed of two factors, intrinsic and extrinsic value. Out of the money option premiums consist of solely extrinsic value. So let's talk about this first. What is the premium? The premium is what we pay to reserve those shares. Hey, Mr. Farmer, I love your home. Here's $10,000 if you again allow me to buy your house for $200,000, the strike price over the next 2 years. The premium was me giving Mr. Farmer $10,000. And that's him saying, all right, you gave me 10K cash. You can buy this one $200,000 whenever you would like, right? Or within that expiration date. Okay? And the expiration date is going to be, of course, the last day that you can exercise your right within that contract. After 2 years pass, if all of a sudden on 2.5 years, the farming house market goes insane, I can't walk up to Mr. Farmer and say, hey, I give you $10,000. He picks up this contract. You say, yeah, buddy, but right here, again, you said this contract ends on June 3rd. Guess what it is right now? It's June 5th. This is no longer valid. You gave me $10,000, but you know what? Expiration date ended on this contract. If you want to do it again, give me another $10,000. We'll pick a new again premium. We'll pick a new strike price. My house is now worth $350,000. Give me again. I see that it's moving on up. I actually want again $20,000 this time. I want $20,000 in my hand. That's the premium for you to buy this within the next 2 years. If you think this is going to be moving on up, strike price is $350,000. If it keeps moving on up, you can buy again this home for $350,000 at some point before our expiration date. Let's make it again within the next 2 years. So that's how these work on out, because expiration dates are very important. In our next lesson coming on up, we are going to be talking about time value and time decay. So that is something that you may want to start thinking about and maybe even start researching, because this is going to add a whole nother level to our option trading. And by adding this whole nother level, as time gets closer to that contract becoming ripped up by Mr. Farmer, your contract is getting least and least and least valuable. It's getting lower value, because if anyone wanted to buy this contract off of you, guess what? It doesn't have much time left. So when you have a lot of time to do something, you're not as in such an urge. You're not as in such a panic. But the thing is, once time starts kind of limiting itself, that's when these contracts are going to start losing value quickly. So expiration dates and picking the correct expiration date are very, very important. So let's start talking about, how to be able to enter in on a trade. So let's bring this on over right now, traders. Here is my current, of course, live option trade. Now, my live option trade at this moment, we have the S&P 500. The S&P 500, I have until December 16th. You guys can all see S&P 500, December 16th, 2022. Let me see if I can bring that right back on up. There it is. And that's at the strike price of 372, right? So I have 6 contracts here. Now, this again, total value of this contract at this time is currently sitting with about $9,813. That's the value of it. Now, as again, the S&P 500 starts moving on up higher and higher and higher, my value is going to become more valuable. It's going to go up higher and higher and higher and higher. I put in about $9,200 on this trade, and you could see my P&L today, $624. My unrealized P&L is about $266. Once I cross my strike price of 372 right here, I'll be able to start making a lot more money in a quicker fashion and a lot more profit. But really, my strike price is I need to get above 372. So how do we place these type of orders? Well, you'd bring up your order box right here. Now on E-Trade Pro, they make it very simple and very easy. I have stocks, And why would I want to buy the S&P 500 right now at the price of 371? Well, 371, do I have $371,000 that I can go ahead and purchase, let's say 1,000 shares? The answer is no. Just like I don't have 250,000 that I can go ahead and purchase that Lamborghini. So instead, I'm going to do an option, which essentially is me leasing out these contracts, leasing out these shares, and if they gain value over time, that's where I'll be able to make a very nice profit. So what do we have here? I would type in SPY. Once I type in SPY, I want to just start. I always just start with, 5 contracts. It doesn't really matter what you put in because we're going to have to change it depending on what the price of those are. And let's say I believe that the stock market's going to climb. I think the stock market's going to keep going on up, and I think the stock market is going to make us money. So I want to do a call here. Now, the next thing I want to do is I want to be able to figure out my strike price or my expiration. My expiration, how long do I want to give myself for this play, the S&P 500, to continue to move on up? Well, I think the S&P 500 right now, if I take a look at the S&P 500, it has been falling for the last 10 months. And for the first time, it looks like we're starting to get a bounce play. We have been falling for 10 months in a row, and we're bouncing off the 200-day moving average, and we have our first big green candle here. Okay, nice. I like that. Now, I think it's actually going to go all the way up towards around this 391 area. I think 391 is where we're going to get up to within the next 2 to 3 weeks. All right, awesome. So I would go over and I would say expiration. How long do I think that's going to happen? I think it's going to take 2 to 3 weeks to happen. But we also got to remember that time decay is going to take it into an effect. So we don't want to just try to match it perfectly at the end. We want to give it some room. So let's go back and let's take a step back here. And let's say I want to be able to have these contracts until, let's say, March of next year. I can exercise them until March whenever I would like. Now, the strike price is where we need to start getting over to start making a profit. Now, you can make your strike price right now right at 370.80. So if I wanted to, I could do 371. But what do we have here? The last price is going to be how much it costs us. And how we do this is we have last price times this by 100. So what is 27 times 100? And what we have is $2,700. So this is going to be $2,700. This is what we're giving to Mr. Farmer to say, hey, I can be able to purchase these shares or exercise these shares whenever I want at the strike price of 371 before March 17th. And if all of a sudden by March, let's say by January, let's say by February, we're all the way up at 400, maybe we're even up higher, we're at 418, maybe we're all the way up at 430. Guess what? We can go ahead and we can sell these if we want to. Right? So that's the beautiful thing. But the better the odds of us winning, the more expensive they become. So let's say, hey, I don't have $2,700. Well, what could we do? We could make the strike price a little bit farther away because we would be in the money right away. So what if we say, all right, we won't start making any money until we even get up to 390, right? Now, again, those options are less expensive. Now, you still will make money as you run up to your strike price, as you're getting closer and closer and closer to that strike price. But once you cross over your strike, that's where, again, your contracts become the most valuable. But you will still make money as you go up to your strike price, as you are getting more valuable than you just were. So just always make sure that you guys remember that. From there, we always want to avoid doing market orders. We want to do limit orders. So I don't understand this deck. How can we get the best limit order? The easy little cheat sheet to get the best entry is whatever the ask is. Just double click this. So if I double click, it'll say 1735 or 1738, and that's going to get filled at my entry price. So the ask is doink doink. That just changed it to 1735, and then I can go ahead and click buy right away. So if I wanted to do this contract, I would do, let's say, one contract here, right? One contract, S&P 500, we can change this to whatever you want it to, and then you would click buy. Boom. Get in on a buy. Then what could you do to get out? You just click sell. Boom, you could click sell. All right, well, Deck, what if I wanted to do a put contract? If I wanted to do a put contract, well, guess what I would do here? Well, I could do a sell option, or excuse me, do I have to? A lot of people, what I wanted to say is if you're used to shorting, you have to click sell first, and then you got to click buy. You do not need to do that with options. With options, you still click buy and sell. So if you have a call, it's buy and sell. If you have a put, it's still buy and sell. I know what shares, what do you have to do? Shares, you have to click buy and sell, and then you have to click short and cover. Or if you don't have the buttons of short and cover, you have to click sell then buy, right? You do not need to do that with options. It is still buy and sell, okay? Now, as you can see, there's a lot of different ways to be able to trade options. You could do cover call spreads. You could do butterflies. You could do iron butterfly. You could condors, iron condors, which is so much, difference in these options and how you can be able to make money through option trading. Basic option trading is honestly all you need to be able to make money starting on off. I think the S&P 500 before the date of December 16th, we are going to be above the price of 372. So it's October 20th right now. Who here thinks that before December 16th, we are going to get up another 45 cents? We are going to go up to 380, 390, 400. I think every hand would go up. 45 cent stack within the next 2 months? Yeah, I think, again, you're going to be able to have a good option. Exactly. And I'm going to be able to make money off of this. So that's where we can be able to profit, and that's what we can be able to gain. So going into this lesson today, I wanted to speak to you guys about the fundamentals, about understanding the principles of option trading, how they worked. And whenever you get a little stuck, think about, again, that farming example, walking up to Mr. Farmer and understanding, where's the strike price? 200,000. What's the premium? 10,000. Do I need to again purchase this house if it decreases in value? No, but I already lost that $10,000. Could I purchase it if it goes up in value? Yes. Okay, I can understand how option trading work. And that's all option trading is. So now you can apply it instead of a farmhouse, apply it to, again, a stock's price or shares of that stock. All right. Awesome job. If you have any questions, as always, please let me know. But great job. Great work. Wrapping up day one of our options bootcamp.